Right now, as you watch this, your bank is making money off you in at least 4 different ways, and if you're like most people, you could only name one of them. That's not an accident. The entire business model depends on you not looking too closely. And here's the thing. None of it is illegal. None of it is even hidden, technically. It's all there, in the fine print, in the fee schedules, in the interest rates, designed to be boring enough that you never read it. So today, we're going to read it together. 4 ways your bank quietly profits from your inattention, and what the people who figured it out do differently. Fair warning, number 3 is the one that costs the average family the most, and almost nobody has ever done the math on it. Let's start with the most basic one, the one hiding in plain sight. Number 1. Your deposit is their product. When you put money in a checking account, it doesn't sit in a vault with your name on it. The bank lends it out, mortgages, car loans, credit cards, at 5, 7, 20% interest. And what do they pay you for supplying the raw material? On the average checking account, essentially nothing. 0.01% is common. Think about that spread for a second. They borrow from you at 0 and lend at 7. You are not the customer in this transaction. You're the supplier, and you're supplying at the worst rate in the entire market. Now, banks would say, that's the price of convenience, of branches, of the app. Fine. But here's what changed, and what most people over 40 haven't updated on. High-yield savings accounts now exist at real government-insured institutions, paying 50, 100, sometimes 400 times the interest of a standard account. Same insurance, same safety. The only difference is you have to move the money. The banks are counting, literally, in their forecasts, on you not bothering. Inertia is a line item in their revenue model. Number 2, the fee maze. Monthly maintenance fees, minimum balance fees, overdraft fees, out-of-network ATM fees, paper statement fees, wire fees. Each one small enough to shrug at. Together, American households pay hundreds of dollars a year in bank fees on average, and the burden lands hardest on the people with the least because low balances trigger the most penalties. Here's what the fee schedule is really testing: your attention. Every single one of those fees is avoidable. There's almost always a no-fee account, a minimum balance workaround, a fee refunding alternative. The fees don't exist because banking your money costs them that much. They exist because a percentage of customers will never check. The fee isn't a service charge. It's an inattention tax. Number 3, the big one, the loyalty penalty. This is the one that costs families the most, so stay with me. Banks give their best rates on savings, on mortgages, on everything to new customers. The longer you stay, the worse your deal quietly becomes. Your savings rate stays frozen while new customers get promotional rates. Your mortgage sits above market while the same bank advertises better terms in its window. In the industry, there's a phrase for pricing that gets worse the longer you stay: the loyalty penalty. Regulators in several countries have investigated exactly this practice, and it works because of something deeply human. We treat our bank like a relationship. We've been with them 20 years. We feel vaguely disloyal comparing rates. Meanwhile, the bank feels nothing. It's pricing your loyalty as a discount it no longer needs to give you. Run one number tonight. Take your mortgage rate, your savings rate, and compare them to what's advertised, not by other banks, by your bank, to new customers. That gap, multiplied by your balances, is what 20 years of loyalty is costing you per year. For a typical household, it's 4 figures, annually. Quick pause, because if you're mentally checking your own accounts right now, this channel is built for you. Subscribe if you want this twice a week. Plain English breakdowns of what banks, markets, and AI are quietly doing to your money, made specifically for people over 40 who have real savings to protect and no time for hype. It takes one click, and it genuinely decides whether this channel grows. Okay, number 4. This one's the newest, and it involves you being watched. Number 4, your data is the new interest. Every swipe of your card tells a story. Where you shop, what you buy, when you're struggling, when you splurge. Banks and payment networks analyze that data, and increasingly they monetize it. Targeted offers, personalized products, partnerships with retailers, analytics sold in aggregate. You know those cashback offers that feel weirdly specific to you? That's not generosity. That's your own purchase history being rented back to you. Is it a scandal? Not exactly. You agreed to it, on page 30-something of a document nobody reads. But understand the shape of the modern bank. It profits from your deposits, your fees, your loyalty, and now your behavior. You're not just the supplier anymore, you're also the product data. So what do you do with all this? 3 moves, none of them radical, all of them boring, which is exactly why they work. First, separate your money by job. Checking account for daily flow, keep it lean. Savings in an actual high-yield account, insured, real interest. The 5 minutes it takes to open one is the highest paid 5 minutes available to a normal person right now. Second, audit your fees once a year. Pull 12 months of statements, add up every fee, and call the bank with one sentence. I'm looking at alternatives. What can you do about these? Banks have retention offers they never advertise. The customers who ask, get. The customers who don't, fund it. Third, become a rate mercenary. Not disloyal, unsentimental. Your bank is a vendor, not a relative. Every year or two, compare what new customers get to what you get, and either demand parity or move. The entire loyalty penalty model collapses against customers who check. It only works on customers who trust. Here's the bottom line. Your bank isn't evil. It's a business, doing what businesses do, charging what the customer will tolerate. The problem is that for decades, the customer was trained to tolerate almost anything, to never read the fine print, never compare, never call, never move. Every dollar of that model is funded by inattention, which means the fix isn't anger, it's attention. 15 minutes a year of paying attention makes you the customer banks lose money on, and that's exactly the customer you want to be. And if this video made you think about where your money sits, wait until you see what's quietly happening to the money in your retirement account. That one's bigger, it's moving faster, and almost nobody's watching it. The video is on your screen right now. Watch it next.